We just talked generally about internal controls. So let's look at the process that a company is supposed to go through to issue a check or to buy something. Um, First of all, someone needs to put in a purchase order. Someone high up needs to authorize a purchase. So that's usually like a manager saying, hey, we need to buy this, so here's my signature, authorize it. Someone else sends it off and sends in the order to somewhere, and then they will receive it. And someone else has to receive the product. So again, no one is ordering things that they're not supposed to. So we have someone authorizing it, someone receiving it, and then someone else needs to pay it. So they get the invoice and they look at all the paperwork. All right, it's authorized. We got it. We get the invoice from the company, and we then put it into the computer system. We issue a check, and someone else has to sign the check that's authorized to do it, because again, we said separation of duties. The person creating the check should not be the one signing the check. And then we finally mail it off. This process can take a really long time. And let's say we want to run across the street to get some donuts for an upcoming employee meeting in 30 minutes. Well, guess what? To buy something in a company using the exact, control procedures that we're supposed to be doing, it's just too much to just go get donuts across the street. So we need a shortcut system to be able to just go buy donuts without going through this whole authorization procedure and ordering and all of that stuff. We just want to go get donuts. Small dollar type of thing. It's not worth it to go through this entire check writing process just to get donuts. So most companies have what they call petty cash. And this is just a small amount of cash sitting in a box underneath someone's counter or in their desk or something. And it's just a small amount. We don't want large amounts of cash because that would be bad, right? People could steal that. This is small amounts of cash for these small purchases that we just need to go out and get it. And the whole reason, again, we're doing this is to simplify the process of buying this small stuff that we need, like donuts or paper, perhaps for the printer, postage. Again, we don't want to run through the whole process that we usually need to buy stuff. All right, so we are going to get some money into a box and put it in someone's desk. We also want to simplify some other things like the accounting. For this small dollar stuff, we don't want to be writing journal entries every time someone runs across the street to get donuts. So when we're talking about the journal entries here, we could do a journal entry every time someone runs across the street to get a donut, but we don't really want to. That's a lot of work as well. To put in a journal entry in a computer system, generally you need authorization. Like your manager needs to authorize it, and then it needs to be checked up on. So we don't want to do this every time we get donuts. So we are going to wait a while to do all the journal entries all at once. Again, simplify our life. All right, so how this typically works. I'll just walk through the procedure first, and then we'll do the journal entries. First, we say, hey, we need a box of cash for this small dollar stuff. Let's go to the bank and pull some cash out of the bank. And so we pull $200 out of the bank and we put it in the box and give it to somebody and say, you're in charge of the petty cash box. And we might give them a key because, again, we need this. It is cash, so it needs to be locked up. So we give someone a box with a key, and they probably put it in their desk or somewhere. All right, now comes time for the employee meeting. The employees are meeting probably in 30 minutes, and we say, hey, we forgot to get donuts for this meeting. And we tell Ricky, hey, can you run across the street to the gas station and just pick up a dozen donuts or something for our employee meeting. And he says, all right, sure, I can go do that. I need some money. And they say, oh, Sally has the money. So just go ask Sally for some petty cash. So Sally is sitting at her desk and she says, oh, hi, Ricky. And Ricky says, all right, I need to go get some donuts across the street. And Sally says, okay, here's $20. She pulls out the box of cash, opens it up, and says, here's $20. And please get me a receipt and give me the change back when you are done. So Ricky runs across the street, takes that $20 bill, buys a dozen donuts, and brings the donuts back to the employee meeting, and then also gives Sally back the change and the receipt. Sally takes the change and the receipt and puts all of that back into the box. So now what's in the box? Let's say the donuts cost $15. So Sally was supposed to get a $5 bill back and a receipt for $15. So now what's sitting in the petty cash box? Well, there's $15 was spent, so there should be $185 in there and a receipt for $15. So everything still equals $200. The cash plus the receipts equal $200 at all times, or at least it should. We'll get to situations where it doesn't later, but it should equal $200 at all times. All right, so we go through this process probably several more times, and one of those times, Sally looks in the box and says, hey, we're running a little low on cash. We need to go back to the bank and get more money. Now, this whole time, every time Sally got a receipt, she did not log into the computer and enter a journal entry every time she got a $15 receipt. Again, we're trying to save time here, simplify our lives, so we're not going to do that until later. And when that time comes, when Sally opens up the box and says, we're running a little low on cash, let's go back to the bank, that's when we do the journal entries. Sally takes out all of the receipts and says, all right, these ones were for donuts, these ones were for supplies, this was for some postage, these were dinner entertainment expenses. So we separate all of the receipts out into the various piles and say, all right, these are the entertainment expenses. This is postage expense. These are supplies expenses. And we make a journal entry at that time. And then we go to the bank and get the money that we need to bring the box back up to $200, which should be, again, the total of the receipts. The money that we spent should be the money we need to pull out of the bank to get our box back up to 200. Doesn't always work perfectly, but again, we'll talk about how we handle that situation in a little bit. All right, so at this point, let's look at the journal entries that are required to do this entire system. All right, so let's first look at pulling the money out of the bank. It's called establishing the petty cash fund, or establishing, some textbooks call it the imprest fund. So I like just calling it the petty cash fund. We pull money out of the bank and put it into a box. We still have cash. Now, when we talk about the cash account, that equals our bank account. So in our chart of accounts that we've worked on up until now, when we say cash, that means our bank. Well, this cash is no longer in our bank, so we are going to make a new account, meaning this is cash not in the bank, and it's the petty cash account. So that's our new account. So we are taking money out of the cash account, which means we need to credit cash, and we are putting it into the petty cash box, or the petty cash account. So we will debit petty cash 200 and credit cash 200. All right, It's all cash. It's all still cash. It's just where is the cash? $200 is now in the petty cash box, and $200 was taken out of the bank account. All right, so that's to establish the petty cash fund. Again, we could make journal entries every single time whenever we get a receipt, but we really don't want to. So we're just going to save up those receipts until we look in the box and say, okay, it's time to get more cash, so let's make a journal entry now. Let's see. I'm trying to move this. There we go. That one up here. Okay. All right, so let's say we had a receipt for donuts for 15. We had to go buy some paper. Let's say that cost $20. Postage. We had to go mail something. Let's say that cost $10. And a dinner. Maybe we took a client out to a quick lunch or something. Let's say that cost $30. And let's throw one more in here. We had to go buy some pens. And let's say those cost $10. All right. So we have a total of, let's say we spent 50, 60, 70, $85. We spent $85. And Sally looks in the box. We have $115 left, and Sally says, you know what? It's time to go get this back up to $200 in case we have a large petty cash expense. I just want to make sure we have $200 in here. So Sally now makes a journal entry. And what we're first going to do is we say, all right, again, to make our lives easier, we're going to combine the like things. So we say, all right, donuts, let's call that miscellaneous expense. I don't have a donuts expense unless you spend a lot of money on donuts. Usually I'll just throw that into miscellaneous. Paper is going to be supplies. Postage, call that postage expense. Could go in miscellaneous as well. Maybe you have a miscellaneous expense for that. Dinner, let's call that entertainment expense. And then pens is going to be another supply. So we have two supplies here. We can combine those two into one line. So instead of saying debit supplies 20 and then debit supplies 10, let's just debit supplies 30. So we got $30 in supplies. And then we had a miscellaneous expense of 15. I don't think we can combine anything else, so we're just going to start listing the stuff. And where do I get these accounts? I look at the chart of accounts and just find something that fits, just like any other transaction. And then I think that was it. Yep, 4. 67, yep, that's 85. All right, so, and I'm going to do this a little bit differently than most accounting textbooks do, just to show you why we do it the way that the textbook teaches. So if I said, all right, we spent $85 out of the petty cash box, we'd say, all right, we credit petty cash $85. Okay, and then what do we go get from the bank? Well, we go pull $85 out of the bank and put it in the petty cash box. That sounds very much like this other entry that we did right here. So we debit petty cash 85 and credit cash 85. So we pulled $85 out of the bank, put it back in the petty cash box. All right. So that's the process, or those are the journal entries that we would make when we are replenishing the petty cash fund. So we're saying, all right, we need to get more money into the petty cash box. We add up all the receipts, categorize them into wherever they're supposed to go, supplies, miscellaneous expenses, and so on. And then we go get more cash out of the bank. All right, we can simplify our lives a little bit more. Instead of doing 2 journal entries, so right here I said, all right, here's pulling the money out of the petty cash box. Then here is pulling the money out of the bank and putting it back in the petty cash box. Well, if I combined these 2 journal entries into one, I have a duplication here. The petty cash accounts cancel out. So this petty cash credit and the petty cash debit, they're the same amount. They cancel each other out. So what every accounting textbook I've seen teaches is you do not have to credit and then debit the petty cash fund. Instead, I am just going to list all of my debits here. The debits are all of the receipts, and then I will credit cash. I skip that intervening step where I am crediting petty cash and debiting petty cash. So I just have debit supplies, debit miscellaneous expense, debit postage, debit entertainment, credit cash. I never have to touch the petty cash account again after establishing it. So whenever I'm replenishing the petty cash fund, I do not have to use the petty cash account. I just skip it. It's a shortcut, and I know it might be a little hard to understand it at first, but we're just cutting out a step that we don't necessarily need. On a test, I don't really care if you credit petty cash and then debit petty cash. But you might have problems on auto-graded homework, for example. If you try to credit petty cash, it won't like it. So just do it that way. All right, there is one more journal entry that we need to cover with petty cash, and that is, what if we end up needing more money in the box? And that is simply saying, all right, instead of $200, Sally comes back and says, you know what, I'm having to go get money out of the bank too often now. Can we boost it to $300 in the box? And that is fairly easy to do. It's just like this original entry, except we're pulling $100 more out. So we would debit petty cash 100, credit cash 100. So now we should have $300 in the petty cash box. All right, let's go over one more scenario. I said we would cover what happens if the receipts don't match the amount of money missing. So let's say in this scenario, Sally adds up all the receipts and it's $85 of receipts. She looks in the petty cash box expecting to find $115, and she only sees $110. Well, there's $5 missing. She doesn't know what happened to that $5. Does this happen? Of course it does. Maybe Ricky forgot to give the $5 in change back. Maybe someone else went and got a $5 item with petty cash and forgot to give Sally the receipt. So there's multiple scenarios where we could be short of cash in the box, and that's okay. It happens. As long as it's not too much and too often, right? So if it's too much missing and too often missing, then we might have someone taking money out of the box they're not supposed to. In that case, to get us back up to $200, Sally says, hey, I only have $110 in the box. that means I need 90 to get back up to 200. So instead of crediting cash 85, I would credit cash 90. But that leaves me a problem in my journal entry. It doesn't balance. I need $5 and I need to put it somewhere to make the journal entry work. I am going to put it in an account called cash short and over. Eventually, this gets merged with miscellaneous expenses on the income statement because it's going to be hopefully a very small dollar amount. So we just kind of combine it with miscellaneous expenses at the end. But in our journal entries, we're going to track how much cash we are either short. In this case, we're short $5, or it could be we're over $5, like someone gave us too much change. They accidentally gave us $5 too much in change, maybe out of their own wallet and didn't realize it. So it can go either way, but most often we are short, which means we debit the cash short and over account $5. If we have too much, then we will credit the cash short and over account. That doesn't happen quite as often as the debit. All right, so if you need to fix things, adjust things because your receipts don't match the amount of cash in the box, use the cash short and over account to make the journal entry work. Again, reminding you, this is supposed to simplify our lives, not make it more complicated. So we are taking a few shortcuts here. We're kind of bypassing a few internal controls that we would usually need to make a purchase. And we are also not making journal entries every time we buy something. We're just waiting a while and putting it all in one journal entry. All right, so hopefully that helps you visualize the whole system and the journal entries that go along with the petty cash.